Morning there.
Hey, John.
Ready to start going on this?
What a weekend, eh?
Oh,
We've seen each other quite a bit.
yes, it is
during
tax.
season.
It is tax season in full swing, and the fact that they even got us to come down here and talk about this tells you how important this is. Because right now, I am not thinking. Well, we are thinking about this tax planning and where this is going. We're absolutely thinking about it, but I just kind of wish that we could just actually do a tax return and not have to think about going forward. Wouldn't that be nice?
Oh, yeah. I can't wait for things to be a little more normal, but with taxes, that might not ever happen.
I don't think that will happen again.
Well, it's not official, but word on the street is that the government has spent some money over the past few months, and now they're going to have to start paying for that. And what does that mean? Taxes. Today's video is the first in a series of conversations between Jon and Jeff regarding tax changes and how they may affect you. In this video, Jon and Jeff give an overview of pending tax legislation and point out some aspects that you should be aware of. In upcoming conversations, we'll delve deeper into the topics, how you will be impacted, and some of the planning you may be able to do in anticipation of the changes to come. So please stay tuned for those.
Really what started my feeling of this early on in the tax season is we saw all these taxes, or all of these proposals coming through. If you watched the recent annual meeting from Berkshire Hathaway, I think it was, I forget which one of them said it is, America is dumbed down now when they hear the $1 trillion, but they're motivated by $1,400.
Yes.
It's such a unique anomaly that we're dealing with in America, is that you hear the $1 trillion number and you're like, whatever. But then 1,400 makes a difference and moves people's mentalities. So how is it that you're seeing both things? And it's just a fundamental and economic shift. And what that's leading to is that we're going to have to see increases. I tell people as an accountant, you're never going to get your accountant to say 100% certainty. But in about as much certainty as I can possibly get as an accountant, taxes are going to go up. Whether you want to call it 99% chance or 95 or wherever it is, taxes are going to go up. And so we have to be planning for that. We need to be thinking about that.
In some form, taxes got to go up.
Yeah.
And it's difficult as planners right now because nothing is set in stone at the moment. We just have proposals. We don't know what Congress, Senate's going to pass. And so what we plan for now, what we strategize for now at this moment is almost impossible other than just knowing taxes will go up. So there are some tried and true planning methods that we could hang on to under an environment of increasing taxes.
Yeah, and I want to go back to, again, this particular article that we read. It was Brian Westbury, a chief economics, deputy chief economic. And he was pointing out here in this article that if you look and you were to tax the top brackets, so the 32, 35, and 37 top tax brackets. So in theory, those are the making more than $400,000. So this is getting into the idea that says we're not going to increase any taxes for if you make less than $400,000. If you take those top three tax brackets and you tax them and move them to the 39.6%, which was what they're proposing to do here within this the transportation budget.
Right.
The increase that the IRS, that the government would receive is $13 billion a year.
Oh,
that's a big number. 13 billion is a big number.
It's like
but
a rounding error.
That is a rounding error when you start doing trillions.
Yes.
So if you're saying that if you're going to take the 32, 35, and 37, which is your above 400,000 of income, and increase it to 39, it's a rounding error. So now let's just take this a little bit further. If you take those tax brackets, the 32, so anyone making more than 400,000 a year, and you move them to 100% taxes, which, believe me, that's not going to happen. I mean, you could see mass exodus everywhere, and that's ludicrous to say. You would raise $681 billion, which again, $681 billion, that used to be a big number. Now, in light of the trillions of dollars, the multiples of trillions of dollars that they have recently done through the first, second, and third stimulus act, plus the transportation, and now plus the new one that they're talking about, $681 billion. That's all that will generate. So that's if you take the top earners over $400,000 and tax them at 100%. What that tells me is that there is no way that they are going to be able to just stay at the above 400,000. So then you go, okay, well they're going to hit corporates. So we're going to take the corporate rate from 21 to 28%. That number comes out to be $418 billion that they're generating. So even if you're talking of going from 21 to 28, from everyone over 400,000 paying 100% taxes, you're still just over $1 trillion a year of generation of income. And they just passed well over $5 trillion worth of stimulus dollars. So this is going to impact everybody that's in America. I don't care what level you are going to feel the impact of all these different tax increases. It's going to come in different ways, but
maybe round one is we're going to tax the high income earners. Round two, a year or two from now, we'll introduce other things perhaps. Alternative taxes. We're hearing a little bit more about gas tax or tax the number of miles you drive. That's an alternative that would hit everybody.
You're going to see, I think you're seeing the governments are getting more creative on the taxes that they're doing. So this may not become income taxes. You're going to see the franchise taxes. You're going to see the, one example I use is New Mexico. I think is brilliant. They have a very low income tax, but they look at their constituents. Their constituents don't make a lot of income. So what do they use? They use a cell phone tax. So if you look at the fees and surcharges on the cell phones in New Mexico, astronomically high. But instead of the $3 a month maybe that we have in here in Michigan, it might be, say, $25 a month. But you add that up times line and people don't realize it, but it's there and it's built in and they all of a sudden that's how they're paying their taxes. Or Wyoming is the oil and gas taxes. So you've got different creative ways that they're doing this, but all of that you're going to start seeing increases coming from all different areas and all different methods and things. So what we're going to start talking about here over the time is the underlying premise of this is taxes are going to go up. We need to account for that. We can't just say, oh, you're going to do this one item or this one thing, because it's going to be multiple different ways that they're going to be getting it, because they can't do it. There's just not enough revenue generated by using one simple theory. They're going to have to use multiple different ways.
And we've been talking a lot so far on the corporate tax rate, but there are some other avenues of tax increases that we will dive into in more detail in future videos. But you want to give us a flavor, a few of those?
I think the one that I see, that I tell when I'm working through and reading through, and I would say whether it's Republican, Democrat, conservative, liberal, it doesn't matter where we are, is that foreign tax. So I think that it's the Googles and the larger corporations that currently can transfer their profits outside of the United States and then not pay taxes there.
A lower tax environment.
Pay lower tax environment. So it gets pulled in to some extent, but they're doing all these things to shift it out of the U.S. Pulling that tax back in, I see, is going to be probably the number one area that they're going to go to. Most of our clients, it's not going to impact you directly. How it's going to impact you is you're going to see, I'll take the example with Google. Google will then have to raise the rates that they're charging for advertising rent or fees, which then is going to go to their end customer, who's going to pay more in their advertising budget, which then has to increase the fees that they're charging, which then in the roundabout way you're going to get in your increased purchases of goods. So it's a hidden tax there. So I say that because that's one of the elephants in the room, that's where I think they're going to get a fair amount of their top line revenue, the government will. But you as the average taxpayer aren't going to directly feel that. You're not going to go out and change selling a business or selling a stock or selling something because of that increase in tax, which is why I hit on it first, because it's the easy, low-hanging fruit, because it's the most hidden tax that's out there. And so I do see that as one that's recognizing that that's where some of those revenues are going to go to pay for what they just did. But that's the one that's there. I think we're going to talk a little bit about how there's a very good discussion on their lifting or the estate tax that's out there.
Right.
There's one, I'm gonna round when I say this for purposes. Right now, everyone has about a $5.5 million estate exemption. That was doubled to 11. Again, I'm rounding, that's not the exact number, but
Close
the gist.
to 12 now.
It's close to 12 now, yeah. So maybe I'll do 6 and 6. So it's 6 doubled to 12. Most individuals, or most researchers or analysts and projections assume that they're going to let that doubling lapse. So it's going to go from what is now 6 doubled to 12 back to 6.
Back to the basic exemption.
Yeah, back
lifetime
to the
exemption.
basic. There is discussion of whether it's going to drop back down to the 3, to what it was even before that. But that 5 to the 6 number seems, again, my crystal ball shows that, well, it's a big enough number that most people are like, yeah, if you have an estate of 6 million, you should be thinking about it. But it's not going to move the needle between 6 or 12, because either you have it or you don't. But if you're in there, the challenge you need to be thinking about is that's not today's dollars, that's future dollars.
All that appreciation.
Of the appreciation
Right.
that you may have. So you may be thinking, well, you know what, I have, and it may start adding up a little faster than you think. You have a house, you have stock in your closely held company that you've been working through, and you've got your retirement portfolio. That might today be valued at $2.5 million, which now all of a sudden we have to be thinking about it. Where at 12, you didn't even have to think about it. But by doing it to the 5 or the 6, we're going to have to start thinking about it.
Well, another serious proposal that's linked with estate tax is the gift tax arena. And there's consideration of pulling back to make gifts $1 million exempt is all, instead of the 5.5 or 6 million, like it would currently be if it was still coupled with the estate tax.
Yeah.
So only allowing someone to transfer $1 million or under over the course of their life, that will impact many more people.
And what we're saying here is what you're getting a flavor for is we see the need to be doing tax planning and to be thinking through. There's not one of our clients that we're not going to be having discussions with on what are the implications. I don't see, for most, the need to just roll out and just make mass hysteria of making a bunch of fast moves. But it's going to impact individuals, like you said, for this $1 million. Do most people think about donating $1 million this year? No. But do we need to start thinking about how do we use some of these exemptions that are in existence right now versus what may go away? Yep. And so those are things we're going to want to start talking through. And especially like you talked about the estate tax there. Talk a little bit about the uncapping that would potentially come. Again, this is potential, but the uncapping of...
You're talking about the stepped up in basis,
Yes.
getting rid of that?
Yep.
Right. In our practice, we see a ton of individuals who, unfortunately, a loved one just passed away, and now they have this trust to deal with. They have inherited assets, real estate to deal with. And under current law, those assets get stepped up to today's market value so that those who inherit property basically aren't having to pay another capital gains tax when they sell it within a year, let's say. Well, if that goes away, that means every day, Joe and Sally, they inherit something, they're going to end up having to pay a capital gains tax because they're inheriting something that was purchased 30 years ago at a very low price, most likely, and then today it's highly appreciated.
And there's one where, while I don't like the concept of potentially having this, in fact, don't even ever hear me say I like this concept, but what I also see on it is that there's an area, it is an easier place that people will willingly pay taxes without them realizing it. So right now, when you just inherited dollars, you have cash that you may not otherwise have planned on. So maybe you got $1 million through this process. And then if I come to you and say, yeah, you just got $1 million of tax-free, people are flabbergasted. Whereas if they would have paid $200,000 in taxes, it probably wouldn't have hurt them because they're like, oh, well, I netted $800,000. It's $800,000 more than I thought of.
Most people believe that they have to pay some
They
tax.
assume
on
that they're going to have to pay
inheritance.
some tax. And so it's an area where the government can grab these tax proceeds and not have a lot of pushback. Now, what does that mean? An accounting nightmare. What does that mean if you're trying to transfer land? You may have to sell the land, right? So there are closely held businesses, very significant ramifications that come with this, but it's one that I see as a very realistic potential. It's only that right now. It's a potential. We're just talking in theoretical. This is not in place, but it is one that's out there of where they're trying to figure out of how they're going to get and grab to pay for this significant amount of investment that they just put out.
And in this video, I'd really like to drive home the fact that there's a lot of everyday Americans out there who don't feel like that they are wealthy or high income and will be impacted, but in inheritance, all of a sudden, you're going to be impacted, especially capital gains, something we were going to touch on here. They're looking at driving up or doubling the capital gains tax rate on $1 million more of gain. That also could easily happen to someone who just inherited assets. or you're selling your business.
That's the biggest one right there, and that's where I want to kind of end what we're talking about today. Is this is the one that I see is coming faster than I anticipated. It was one that I said, oh, okay, there's going to be no way that they're going to do it retroactively. They're going to probably do it prospectively. But I'm seeing more and more that if they did do something along those lines, it probably would be retroactive, which scares me in this sense. But is that capital gains? And again, they're targeting, and they're politically going faster and more than I would have thought, because they're saying, oh, it's only if you make over $1 million where that's going to apply. They use the words only, and it only affects 0.3% of Americans. I think they're understating that, because it impacts 0.3 Americans that annually make those dollars, yes. But if you have a closely held business that you've been growing and working through for your 30 years of hard working, and then you go to sell that business, if you sell it in 1 year, boom, you might be over $1 million. And you just all of a sudden took your capital gains tax, which would have been 20%, now is at 39% proposed, plus the 3.8, plus all these other ones. And so it does have significant ramifications. And I have several clients that are saying, well, maybe I need to be selling my business this year versus next year. Or I need to be selling some of these significant capital gains that I have that are built into my portfolio that we need to be thinking about.
And those are some planning concepts that we can touch on.
Yeah,
in
so that
another
is one I
video.
think you are going to see future videos on that particular. We've hit lots of different concepts, lots of different methods and ways that we see them coming in. We're going to dive into each one of those on a much more detailed basis, a much more focused basis. But right now what we're coming to you is we're saying we see that taxes are going to be going up. You've got to hear that from us. You've got to look and understand that there's no way around it, is what we are projecting. And so we need to be accounting for that. Today, as it stands here right now, we don't know the details of what it's going to be. We just know it's going to be. As we start planning in the summer months and into next fall in preparation for 2021, we're going to be talking to you. You reach out and ask us questions. We're going to be presenting some of these videos to you. But it's something you need to be thinking about, because you don't just go and sell your business overnight, but that may impact you. But you can't not think about it as well, because if you wait too long to think about these things, it could be too late, and all of a sudden you're now sitting in the 39% tax bracket. I wish I could. A year ago, I couldn't have even fathomed that I would be sitting here telling you that as an opportunity or as a potential. But the idea of selling your business and potentially paying 43% taxes between the ordinary tax rate plus net investment tax plus your state taxes plus others is just ludicrous. But that's there. It's real if this gets passed, if things happen like that. And so, yeah, we're going to be coming to you throughout the summer, talking through with these, planning through with these. If you have questions, give us a call. Thanks for listening, and look forward to talking to you soon.